Hello and welcome to another edition of Nucleus Investment Insights. Apologies for running a little bit late today. We had a few technical problems, but what we really wanted to do today was to run through what are Trump's tax cuts going to do to valuations? Because I think there's certainly we're sort of looking at markets right now where they're very expensive and relative to history, but there's this sort of upcoming tax cuts and what that's going to do and whether there's some growth. And, I think quite often you can run into the trap of not buying markets because they look expensive, but actually the reason they look expensive is because they're factoring in the sort of the amount of growth. And so we wanted to have a look through that and just sort of very much from a long-term perspective today. So just a quick reminder that what you hear today is general in nature. None of it is personal advice. If you do want personal advice, give us a yell and we can have a look at your own circumstances and what might be relevant for you. So without a lot of further ado, I'll jump into this this idea about these long-term returns. And I'm going to look at valuations in two different parts. This week, I'm going to look at it on the long-term side. So these long sort of sweeping changes about, when you want to be sort of more geared towards being overweight equities or underweight equities in a big picture sense. And then we'll look at some of the short-term factors next week and when we sort of dig into this into a bit more detail. So I have a chart up which is showing. Now this is from Robert Schiller, so it's all based on the US, but I think that's obviously the key part we're looking at, particularly in terms of global earnings at the moment. And I just want to highlight, so over the longer term, 6 to 9% return from stock markets is sort of typically thought as a range, and that's where most countries sort of fall into those bands. The danger you have is you can go through some periods where you don't, where that turns into zero or negative for quite a long period of time. And so if you look, for example, at the, just this chart, now this is overstating it because it hasn't got the effective dividends in some of these, but some of that price changes where, from 2000 2008, you basically went nowhere and lost money. And then from 2008 out to sort of 2012, 2015, you sort of went sideways as well from those sort of market peaks. And so I guess the highlight is, yes, you can get these returns in the longer term, but if you're sort of got money invested for the next year or 2 years, then it might not be as applicable for you. But that's sort of the longer term view. Factored into that is this idea of these long-term earnings growth. Now, this data sort of comes from his overall data, but I've factored in some of the other, the red line and the green line. So what we're looking at here is earnings per share growth. Now, over that time, and I've picked 50 years as a 50-year compound return on growth, and just sort of looked at that over time as to how that sort of plays out. Now, the reason, there's no real magic towards that 50 years. It's more just saying, what are we really looking at in this long term, trying to get rid of sort of short-term fluctuations and sort of bouncing around with things like that. But what it shows pretty clearly is that, your 50-year EPS growth has been around 6% for the last, couple of decades. So you're getting that's sort of where you're getting your basis of your return. And when we talk about that 6 to 9%, I think that's where you should be thinking about that sort of underlying your returns. Then on top of that, you've got a dividend yield as well. Say call it 2% in the US market. Sometimes between 1 and 3 is probably sort of a more reasonable expectation. And so that's where you get that longer term return. You can look at and say, okay. Can I expect a 6 to 9% return? Because valuations can go up and down in terms of how much people are prepared to pay for the markets, but in the end they return to that. If you're not getting through that earnings per share growth in the longer term, you're not going to get back to that. Valuations markets can look expensive, but eventually they'll look cheap. And if you don't have anything underlying it, then eventually they'll return to the fundamentals. But the second part of that, which breaks out more clearly, and for anyone listening in the podcast, basically back until the I've also put in some real pre-tax numbers and then and some real EPS growth numbers. And so you're looking at this 50-year EPS growth of being sort of 6%, but the real EPS growth spent most of the 1900s below 2%, and then for the last maybe 40 odd years, we've been looking at sort of 2% to 3% in terms of that real EPS growth. So that's earnings per share growth after inflation. So maybe if you're looking at that and keeping in mind that the last 50 years still does got a few high inflation periods, but if you sort of go, well, if I can get real EPS growth of sort of 2 to 3%, and then I can add on another 2% or so of inflation, it sort of gets or a little bit more. Maybe that gets you back to that sort of 5 or 6% growth, and then you add your dividends, and that's why you're getting your return. The interesting part, though, when you break that out, is I've got this pre-tax number in there as well that I'm going to sort of focus on a little bit more. And this is actually a pre-tax, more of a dollar amount, that less of a per share amount, and adjusted for various factors to get it sort of on a as much of a like-for-like basis as you can get. But what it's really showing there is that there's a gap between that, what's happening on the real pre-tax numbers, which used to be sort of above 2%, sort of back in the 1900s, and now is basically running at zero on a real pre-tax level. And it has done for the last 30, 40 years. And keeping in mind, this is a 30, 40 years of 50-year averages. So there's averages amongst averages here. But it is giving you an idea of that real trend pre-tax growth that you're getting, which is not very much at all. And the question, why is real EPS above that? And how do you get from 0% real pre-tax to sort of 2.5% of real EPS? And the answer is financial engineering and tax cuts. So buybacks in particular were illegal sort of back in the pre-1980s, and so that's probably one of the biggest things we've seen in terms of the divergence. But also tax cuts as well has been this huge divergence between these numbers, and so it sort of comes back to this idea that how sustainable are these in the long term? So if you're not getting any real earnings growth, and you're relying on financial engineering and tax cuts, what's your long-term expectation? And so I guess the short answer is tax cuts. Well, we're about to see another round of it, so that they can go further. But you're getting lower and lower returns. It's one thing from when you go from 50 or 60% corporate tax rates, and that brings its way down to 20%. But now that you're sort of 20 to 15 and sort of going further down, the effect is much less. You need to have you've just got much lower tax cuts you can actually make. The financial engineering side is actually is probably more sustainable than you might think. Financial engineering always sounds like it's a bad thing, and in some cases where you're just gearing up, that can be a bad thing in terms of just adding debt to it. But when I'm talking financial engineering here, I guess I'm talking a couple of different measures. And one of them in particular is the idea of buybacks and how that distorts some of these numbers in that, I'll jump into that in a bit more detail, but that is a bit more of a sustainable trend in terms of how we're looking at that. Okay, so we've got this sort of long-term view of stock markets doing 6 to 9%, underpinned by real earnings growth of sort of 2%, 2 to 3%, adding some inflation, adding some dividend yields, and sort of getting us home. Now, we're going to look at some valuation measures and on a similar basis. And why I picked that, and what we're going to look at is this idea of the Shiller PE. And so what the Shiller PE is effectively doing is it's trying to say, and it's quite a widely used measure that sort of looks back in time at various various earnings and how to get to, when is the market cheap and when's it expensive. And the idea is that we're going to take a 10-year average of earnings, But if you're taking a 10-year average of earnings, then the earnings from 10 years ago is not really that comparable to the earnings from today, just on an inflation adjusted basis. So it's basically saying, well, if I just took the earnings from 10 years ago, took it up by 10 years of inflation, and then I get the earnings from 9 years ago with up by 9 years of inflation, and et cetera, then I get a much more realistic look at what's happening in terms of earnings. And so that's what Shiller does. And he creates this cyclical PE measure, sometimes known as the Shiller PE, sometimes known as CAPE PE, CAPE standing for cyclically adjusted price to earnings ratio. And it's a nice sort of long-term view and all that type of stuff like that. The big problem is, you've had one buy signal in 40 years. I think we might even be closing in on 50 years now with one buy signal. And so at some point you're like, well, that's, maybe, is this a problem with the markets just being irrational, or actually maybe is this a problem that the measure is not measuring what we thought it might be? And I'm sort of more into the latter case. There's some nuanced views, but I'll jump into the big changes that we make to sort of bring this back into a more reasonable level. So the first one is exactly what we're about to go through now. So if we're looking at 10 years worth of earnings, then the earnings from 10 years ago had a 35% tax rate. The earnings from this year have got a 21% tax rate in the US. The earnings from next year or the year after are probably going to have a 15% tax rate. And so there's this idea between those three is that, well, when people are looking at this going forward, they're not worried about, so when market participants are looking at this, they're not looking and saying, okay, this company earned, say they earned $100 pre-tax the whole time. They're not looking at the $65 that earned post-tax 10 years ago and saying, oh, that's the right number to use. They're looking at it saying, well, if the company earned $100 pre-tax, well, next year they'll be earning $85 post-tax. They won't be earning $65. I'm not going to use tax rates from 10 years ago to try and value companies today. And so that's sort of one change you can make in terms of this. And then the second change is looking at this on the buybacks adjusted perspective. So what we're saying is, if the market is earning a certain dollar amount of earnings and there is fewer shares today than what there was 10 years ago because of all the buybacks that have been going on, then the price should be higher. And so and so there's that sort of natural, particularly if you're expecting this continued returns, continued buybacks to keep on going, there's this natural sort of uplift you're going to get and markets sort of price in, which is effectively saying, well, if you're buying back 2% of your stock every year, then we're expecting earnings to grow by 2%. And so that's where, we can come up with this idea of this sort of cyclically adjusted CAPE PE ratio, 2.0, which then drops that number by sort of 10, by about 10. So you go from this CAPE ratio of 38 or 39, somewhere around that range where we are now, which is like historically high. Yeah, we've only ever seen those heights in the financial crisis. Sorry, not the financial crisis, in the tech boom, to a much lower level. Still high relative to history, but back to sort of more like 28, 29, which is actually pretty similar to where the CAPE ratio was last time Trump was president and put through that last set of tax cuts. And markets have sort of, obviously done pretty well since then. And so, so it goes from this extreme outlier back to something more normal. Now that's sort of one round of changes, and that's sort of like the changes which you'd say are relatively uncontroversial. I'd like to sort of have a bit of a closer look at some other factors as well and say, well, we've got these statutory tax rates, and then you've got the real tax rates, and there's differences, and there can be quite large differences from year to year. So we need to make adjustments for that. The buybacks, actually, I won't go do too much into more detail on the buybacks, but the idea is that, if you picked if I sort of used as a comparison, I used two different indexes where I bought I spent whatever, $1 million to buy a dividend index, buying an S&P 500 index. And what I'm going to do is, as the dividends come out of that exchange traded fund, I'm just going to pay them straight out to the investor. And then the second one is a buyback index, where what we'll do is instead, every time we get a dividend, we'll use that to buy more shares, and effectively end up with doing a buyback. And so I guess the thing is, if you run that for 10 years going forward, you basically end up with if you're using the cyclically adjusted PE that the Shiller does, you end up with this much higher number, which is why we need to adjust for that. Anyway, so I won't go too much more into detail of that, but there's some other ones we've got as well, which is accounting standards. Some big changes in accounting standards, particularly in terms of write-downs. So write-downs typically used to be companies write things down and they'd write them back up again, and they had a fair bit of free rein to put in the balance sheet the number that they thought was the right number. And nowadays that's not the case. Very much companies are incentivized to write things down, write assets down, but don't have the same ability to write assets back up again. So you don't have that same sort of don't have the same ability. Within that, then you get these fake write-downs as well, that companies sort of write various assets down that they shouldn't write down, and they try and include that in those numbers. So you sort of make some adjustments for that. Goodwill amortization used to be a thing in the past. So it used to be the way companies accounted for acquisitions was different to how they account for them today. And so you need to make adjustments for all of those, sort of going back in time to say, well, just the way you account for things is not the same. Ideally, I'd also like to adjust for negative earnings, but I've only got sort of 20, 30 years of reasonable data on that, and maybe a little bit longer. But once you sort of get back into the 70s and 80s, and before that, the data is much less good. And so, and I guess what I'm saying there in terms of negative earnings is that you can sometimes look at periods, and in particular that Shiller PE period we saw where it went in the tech boom, because there was all these companies with negative earnings, is that I guess what we're saying is companies that are out there losing money, markets aren't then deciding how much to pay for these companies based on how much they're losing. They've got other valuation mechanisms they're getting to. And so if we're looking at, say we had two companies both earning $100 and then another company losing $100, is saying, well, if I'd pay in total for all three companies, I'm paying sort of $2,000 for $200 of earnings, with 100 plus 100 plus minus 100, then that's effectively saying I'm paying a 20 times price to earnings ratio on that. But if the company that's losing money goes broke tomorrow and drops out of the index, now all of a sudden I'm left with two companies. They're still whatever the amount I've pulled it back, but we now might be trading on 10 times earnings. So I guess what I'm saying is you can look at these. You shouldn't penalize the whole market if there's companies losing money. You should say, well, what are the companies that are making money and are being valued on that basis, and let's look at those, and then let's take these other companies that are losing money and assume they're being valued on some other mechanism, and sort of exclude that from the series. But don't have enough data to do that, but that would be a nice one to do as well. The second one, going back in time, and this is really going to make a difference to some of these historical numbers, is that when inflation runs high, you have this really high, you get this understatement. So I built a factory for $100 or $100 million, say, and inflation's running at 10%. In 5 years' time, I'm going to have to replace that factory in 10 years' time. So I built it for $100 million. I'm going to write off $10 million a year every year for the next 10 years, and then in the 10th year, I'm back to zero, and I go out and buy a new factory. But if I've had inflation of running at 10% for that time period, I'm no longer paying I'm no longer paying 100 million for that in 10 years' time. I might be paying 300 million for that. And so what what that ends up happening is I've got a depreciation charge I'm writing off every year of $10 million, but I've actually, the depreciation on a new factory might be $33 million. And so I need to think about the mismatch between what depreciation is and what CapEx is. Now, that sort of doesn't matter for the last 10 years because, well, X this short period of inflation. Before that, for the 20 odd years before that, we just had no inflation, and so it didn't make a difference. But what would happen in the 70s is that the markets, first of all, analysts would routinely make these adjustments, but secondly, things like the stock markets would actually come out and ask companies to show the data and show the replacement cost and actually make an assessment of this. And one of the analysis when in 1977, when they came out with one of these, was that earnings were effectively overstated by almost by more than a third, and that you would drop earnings by 35% if you use replacement cost rather than historical cost as a method. And so, and as this chart's sort of showing it, and this was on a bunch of different companies, was that you go from like a return on shareholders' equity of 15%, which is fantastic, to a return on shareholders' equities of 5.8%, which was probably below inflation at the time. And so, so depreciation makes this big difference. And so we need to make sure that we've adjusted for that back in time as well, for the periods where we did have that high depreciation charges. And then finally, trading costs. Now, there's this issue about returns. And I spoke about that sort of 6 to 9% returns in the long term. And I've got a couple of charts which are probably slightly hard to read on this, but the top one is showing the bid-ask spreads over the last sort of 100 odd years on Dow Jones stocks, and they were sort of around about 0.6, 0.7, as high as almost 0.9 during the 70s and 80s. And so effectively what that meant was every time you were buying a stock, you were losing, close to 0.5% in terms of getting into that stock. Secondly, the commissions and the spreads, the commissions you would pay would be sort of 1% plus to get into these stocks. So there's another chart there sort of showing the commissions over a long period of time. Now, both of those are almost nothing at the moment. So they've decreased to much, much lower levels. And so the question then comes about saying, well, if people were expecting, if I look back and say, your average return from 1900 to 1950 on the market might have been, 8%. But as part of that, people who were doing it were actually paying these much higher prices. And so in reality, they were probably only getting a 6% return or 7% return on it because of the additional costs they had to pay to get in and out. And so, one extra factor that sort of goes into it that says, well, the price you were prepared to pay when you look back a long period of time might not be the same as the price somebody else would be prepared to pay now, because they're not facing the same effect. And so if you bundle all that up and put that through into a change, you end up with this what I've called Cape 3. And I mean, honestly, most of those changes don't make much difference to the current level of the Cape. It's still showing that sort of 29 versus 38 and sort of the Shiller adjusted one. But what it does do is it really pulls up all those numbers historically. There's a whole bunch of periods where a Cape PE of 29 goes to being this one-off anomalous. The only other time it's ever been this high was during the tech boom. To actually, it's been there a bunch. Most of the 50s, 60s, 70s, it was up around these levels. And back in sort of 1900, yes, you've had lots of other periods where it's been lower, but actually the period where it is today is not atypical relative to history. And so, so big picture again. You look at the long term. You look at the Shiller PE on its own, and this is like, it's crazy. We've never been this high before, except during the tech boom. You go back and make a bunch of adjustments for accounting standards and buybacks and in particular for tax rates, and all of a sudden you come back and go, well, actually, yeah, it's expensive, but we've been this expensive in plenty of other times, and returns sort of haven't been as adjusted. So where does it lead us with returns is, if you look at the averages to date, you still are talking on this third one, you're still talking an average of about 20. So, we've been there a few times, but certainly not any time in the last decade or so. Still does look expensive relative to that. If you look at the what you call the excess returns and then the subsequent, actually, I'll skip forward from this one. There's a chart which you can throw up, which sort of basically says, okay, based on what Schiller PE I bought this one on, or actually I'm going to flip it around and go, what excess yield? So what if I look at the Schiller PE and I adjust it relative to bond yields? So when I buy it on a high yield, that's great. I should get a high return. And when I buy it on a low yield, I should get a low return. And so you can see that, the relationship between these, it's all right. It's certainly, there's basically it's a strong relationship on, if you can buy it cheaper, then you get better returns. The R-squareds aren't fantastic, but there's obviously a reasonable amount of information in that you're getting out of this. And there are lots of periods where it goes, completely awry. So effectively, what that's saying is, if you wanted to pick that line, if you can buy this on a yield of it's effectively almost a 1-for-1 relationship. But if you could buy it on a excess CAPE yield of 10%, then you'd expect to get 10% over the next 10 years. At the moment, yields are around 1.9. So yeah, that doesn't look great for the longer term returns. And then there's this question about saying, well, are you, if you look at this, when we were at 1.9%, returns have ranged somewhere between -5% and plus 10% over that period. So obviously a massive difference in returns. I think there's certainly something to sort of bias you on this away from, so bias you, I guess, towards saying the returns are likely to be lower in the longer term. But there's this second phase of about where do we sit in terms of the earnings right now, and what do you want to do in terms of, it's fine to go, yes, the returns might be poor for over the next 10 years, but if that consists of a boom and returns double or triple from here and then followed by a bust, then that's obviously a different environment to one where markets are just going to go sideways and only slightly up for the next 10 years. So so I guess that's one part. Secondly, it's not at the negative phases. So there's certainly lots of times where the excess CAPE yield has been below zero, and typically that's been a much bigger sign that you're going to have a poor market. But yes, I think there's sort of these longer term signs in terms of what we're looking at for the markets. So yeah, I'm going to just jump to a quick sales message, and then we'll come back to the investment views.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, just putting that all back into perspective again. So what we're looking at is markets on a long-term basis that really don't look like they're going to give you great returns for stocks over the next sort of 10 years. We spoke about the earnings factor within that. Is that you want that earnings growth to keep coming through, and then secondly is that and probably the most important point at the moment is if we're looking at tax cuts for corporates, which seems highly likely, then we need to sort of go back and adjust these numbers to say markets are forward looking. They're not looking at the current numbers and saying apply yesterday's tax rates to it. They're looking at the current numbers and applying what they think the tax rate might look like, post once they get the new tax rates get put on. And at that point, you'd sort of look and say, well, markets are expensive, but not historically so. They're probably at the sort of 70th to 80th percentiles on these ranges. And next week, I'm going to have a bit of a deeper dig through some of the sectors that look cheap, and then look at some of these shorter term measures as well. And effectively, they're telling you a very similar thing at the moment. Is markets are expensive, but at the sort of the 70th, 80th percentile for, say, earnings or cash flows, and which does give you some room for upside. And particularly if we are going to see strong earnings growth coming through, and you thought about a situation where lots of fiscal spending, corporates make a lot, elevated profits during that time period, and that sort of turns what looks like current numbers where they are very expensive, but if you can add in that extra growth, all of a sudden comes back to much more reasonable levels. Anyway, we'll dig through more details on that next week. Thanks, everyone. If you need to grab us, you can get it Thursdays, 12:30 live. Pop in any questions on the YouTube. We're also on all the different major podcast platforms. And if you want to register on our website, you can get all this stuff emailed to you every week. And thanks. We will see everyone next week.